It's just as important to identify the losers of your stock portfolio as it is to pick the winners. And that's the theme of our discussion with David Barse, CEO of XOUT Capital. David, welcome back to the show.
Great to be here again, David. Thanks for having me.
Thank you for coming. And we're going to get your macro overview and some of your stock picks. You know, I was helping a friend out last night with her MBA homework, and her assignment is actually to create an ETF, a fictitious ETF that could quote unquote beat alpha or generate alpha according to the assignment. And I actually pointed her out I pointed her to your ETF. I said, look at what this guy did. All he did was he took the index, he removed the losers. By definition, you're going to generate alpha, because all you're left is the winners, right? That's kind of your approach. So tell us your approach and tell us some of the criteria you have for identifying these loser stocks.
Yeah, again, this is so intuitively simple. I'm happy to go help you assist that student with their classwork, because I'm teaching also, and this is part of really what's behind this. There are three really simple insights that give rise to the creation of our strategy. First and foremost is that it is, I posit, easier to eliminate the losers than to pick winners. That flows will continue. Insight number two is flows will continue into passive index strategies, in my view, forever. And insight number three is indices as a fundamental matter have flaws because they buy everything in the index. So if my insight number one is correct, simply by eliminating what's in those indices, you can outperform if you've got a methodology that helps create that deselection process. Yeah, we've been able to prove that we can make it work. So that's how simple it is. It's those three simple insights that give rise to the strategy.
And when we talk about removing the loser stocks, you're not just talking about performance, right? Are you just taking the stocks that have underperformed in their share price and removing them from the index for the last 12, 14, 80 months? It's not as simple as that, right?
No. And so what we do is we're first of all designed around what we believe is one of the most significant forward-facing risks that all companies are facing, which is technological disruption. And so what we've done around that theme is create, in our case, 7 different fundamental metrics that we derive from the publicly reported financial information that each company must report every quarter. And we use those 7 factors, that information, to create a score for each company. So some of those factors are revenue growth, employment growth, whether a company is investing in research and development, what is a company doing in terms of buying back or investing in its own stock, how is the management team addressing technological disruption? And we use those fundamental metrics to give this company a score, and then we eliminate the 250 lowest scores of the 500 largest U.S. market cap companies.
Okay, we'll talk about some of these stocks in a minute, but I'm just looking at your performance fact sheet here. Year to date, you're up 28.5%, with the S&P 500 only up 18%. So you've outperformed the index by about 10%, which is a significant margin. Congratulations. How did you do that? What is the sector that outperformed the most?
Well, again, this was across all sectors, right? We think technological disruption is impacting every company. It's not just technology companies. There does lead to an overweight, if you will, in technology and information technology as a sector, as defined by, for instance, the S&P 500. But as a result of what happens to the 250 companies that we've eliminated, we simply gross the market cap up of the remaining 250 companies that we do own. So naturally, a company like Apple, which is the largest weighted company in the top 500, gets an overweighting in our portfolio. So as a result, also the top 10 companies in the largest 500 companies are now, as commonly referred to, FANG securities, right? FANG stocks. Those companies have gotten a larger weighting in our ETF. And so we have, therefore, an over allocation, if you will, or a higher allocation to information technology as a sector.
I know you don't have an explicit mandate to do this, but it looks like you're becoming a tech fund. Is that a fair characterization?
No, totally unfair. We don't want to be seen as or heard of or even thought of as a technology fund. If you made that statement and applied it to the broad-based U.S. large cap indices, you'd have to kind of say the same thing, because the top 10 companies in almost every broad-based large cap index are going to be predominantly technology companies. So are we going to call them all tech funds too? We're simply using the broad index, and as you started this interview, generating alpha by eliminating those companies you don't want to own. Now, let's pick on one of those eliminations,
Yeah,
Exxon.
please. Yeah, okay.
Exxon was, at the beginning of last year, a significant weighting in, for instance, the S&P 500. By simply removing Exxon from our constituent base, or from our index, or rather from our ETF, because it's in the constituent base, but we've excluded it, we created significant alpha to the portfolio by just not owning it. So there is a possibility at some point in the future that Exxon could get reintroduced into the portfolio if it meets our score and gains their score. It seems, though, that that's an unlikely scenario. But to characterize us as a technology fund because we exclude an Exxon, for instance, isn't right.
Yeah, but by the way, I told my friend to not copy the strategy because it's already been done. That would be cheating. But I doubt the professor. I'm highly skeptical the professor is aware of your fund. It hasn't received as much media attention as it probably should have. Let's talk about your top holdings now. I have to. So Apple, Microsoft, Amazon, Alphabet, Tesla, Facebook, Johnson & Johnson, Walmart, Procter & Gamble, NVIDIA. I have to refer to this quote that I read online about investing. Some people were giving advice to millennials on how to invest. And this is an interesting quote that I read. You should be picking stocks, or at least be looking at stocks for consideration of companies that you use on an everyday basis in your regular life. Because if you're using these products on a regular basis, other people likely are too and will continue to use them in the future. I'm looking at your top fund holdings. I think in some ways it's applicable to that quote, because Apple, Microsoft, Amazon, these are things that people use on a regular basis. Tesla, maybe not so much, but Facebook, Johnson & Johnson. Do you like this philosophy that I just described to you?
Yeah, I think for the millennial generation, it's a really important thing to think about. With my own kids, I have 3 adult children. When they turn 13, I asked them all if they were going to invest in something, pick one security you want to invest in, and make it something that you are a user of. So my eldest daughter chose Apple, and when she's now 28, and so 15 years ago she put her money in Apple, and look how that worked out for her. So I think that's an important tool for the millennials, and I think you see that in the way in which they invest. They get comfortable with a product, something they understand, and then they want to invest in it. And there's nothing wrong with that, especially if they have a long-term time horizon.
So going back to the tech overweight now, David, are you not concerned about some criticism surrounding tech valuations and how they're way too high right now? How would you respond to that?
I think there are a lot of individual securities that have experienced in the last few months some fairly significant rise in values without necessarily a fundamental support. Again, in our portfolio, we're dealing with large cap companies, all of which have been tested and scored against our fundamental factors. And I think tech valuations are not ahead of themselves. And what's going on, for instance, today in the market is just if you will, just a reset, right? You can't go up every single day. And if people are going to get a little bit nervous about valuations because of what's happening in the bond market, that's a good thing. That's a healthy thing for the market. But the companies that we end up owning are continuing to grow, are continuing to add to their labor force, are continuing to invest in their own businesses, are continuing to have good management teams who are thinking about the future and not the day-to-day market gyrations. And so I argue that you have to continue to be an optimist. You have to continue to believe that technology is disrupting everything, and you have to be long these good companies and hang in there for the long term.
So why in particular the large cap bias? Why not go down the value chain to the mid caps or even the small caps? Plenty of disruptive technologies there.
I'm so glad you asked that question. So we're in beta test now with the next index, because XOUT is an index company. We're going to launch another index for the mid cap space, and we're simply just going to take, so for XOUT, it's the largest 500 US market cap companies.
Okay.
For XBID, which will be the ticker for that ultimate ETF, it's the next 400 companies. So we're going to end up covering 900 of the listed US market cap companies in market cap order, and be able to apply a similar methodology to the mid cap space. It's not the same rule. We're not going to come up with the same exact rule because it doesn't work as well with mid cap securities. That's why it's in beta test right now. But it's a great question, because we think the mid cap space is the next area for us to exploit, going back to my 3 insights.
And would that fund have the same target investor demographic, or are you aiming for a different audience here?
No, look, I think our fund is a demographic for everyone. It shouldn't just be for millennials, and it shouldn't just be for retirees. Anyone and everyone.
Well, let me rephrase my question. Would it have the same risk profile?
Yeah, I believe that broad-based indices are the best way to diversify and have a risk mitigation as opposed to single stock selection. And in the case of the large caps, we're using 500 as our constituent base. In the case of mid caps, we'll use 400 securities as our constituent base. Owning 250 and 200 respectively, that's a pretty good risk mitigation tool, because you're not depending on any one or even a select group of securities.
Okay, and this isn't actively.
One last thing I'll add is important. In the mid cap space, you don't have the dominant top 10 holdings, if you will, like you have in the large cap sector.
The one thing I've noticed is that you don't have an exposure to cryptocurrencies or blockchain technology companies. Is that something you're considering at all?
Well, again, that problem seems to be getting solved for us every day as we learn each day about some of these large cap and mega cap companies that are using their treasuries, because they're very cash rich companies right now, and using cryptocurrencies as a tool, because the cash alternative is not very palpable for them. So I'd say to you, we're getting that through other means. But if ultimately, for instance, I think we just found out today, right, Coinbase is going to go through a direct listing. That company is going to have a very significant market cap when it becomes eligible for our constituent base. It has to be a public company for at least 4 quarters. That could become a position in the ultimate ETF at some point in the future.
Okay. Final question, your macro overview on equities markets, given our current economic conditions, given the rise in bond yields, putting it all together. I will comment that last time you were on the show, you had said that stock markets would continue to rise into the new year, and you were correct on that call. I had an economist on the show who was very confident in saying that stocks will drop by about 40% by April, which is a month and a half from now. What's your response to that call?
I would say we should strap that guy in a rubber suit. I can't believe that anyone would think a 40% downdraft is realistic in light of what's likely to occur as we open up the economy and get through the virus. We have been, I think, chilling and suppressing demand. Maybe that's why rates are spiking today. But I remain very much an optimistic bull on the equity market. I think growth will continue to exceed and extend beyond the expectations that the market has set. I think that will happen both in large cap and middle cap market weight securities. And so I'm a bull, and I think whether we have the same, let's call it, significant growth and rise in the market as we saw since the last time you and I spoke about 6 months ago,
Yeah.
That might quell down a little bit. But I'm an optimist, and to say that the market's going to check back 40% because of
40%.
I'm curious what the basis for that statement would be, but I don't see that, especially with the amount of stimulus that's more likely than not going to be pumped into the U.S. economy.
Well, very quickly, he said we're going to have a deflationary event, and we're going to see a lot more bankruptcies in the marketplace that haven't happened already. The bankruptcies take a long time to filter through, and we're going to see that right now.
Yeah, I mean, look, you've seen a bunch in the retail sector. Real estate is still challenged in light of what the lasting effects of the pandemic are going to be to whether people go back to work or not go back to work. But the wave of bankruptcies, unless there's some specific event, catalyst, if you will, for a sector within the marketplace, that's going to drive that kind of event. And spiking rates might impact some of those over-leveraged companies, especially to the extent that their floating rate debt is going to end up costing more money. But I think a lot of financial engineers were very smart when we were given this low rate environment, and refinance balance sheets to do the extensions and what they call extend and pretend to get through the next cycle of the marketplace.
All right. Well, thank you very much, David, for your update. And I look forward to catching up with you again on the next big market move.
All right. Appreciate it, David. Thank you.
And thank you for watching Kitco News. Don't forget to subscribe if you're watching this on YouTube. I'm David Lin.